Hello everybody, back to the webinar series Developing Superb Trading Strategies. My name, as always, Stefan Friedrichowski. Same time, 11 o'clock at the 5th of January 2017. By the way, Happy New Year. I think it's still time to say that at the 5th day of the new year. So I hope you have started well into the 2017. Let's see what the markets will do in this year. Hopefully we will have some additional changes that will make our efforts and strategies a little bit more profitable if we have a little bit more of changes. But anyhow, we have to take what we have, meaning whatever the market is doing, the market is always right, and yeah, we have to see how to do our own trades with that. Good. As you might have seen already, I have uploaded the slides once again, so you can download the slides via the GoToWebinar control panel, so you have every slide directly. Whenever you have additional questions, just send me an email, or if you want to have some additional material shown within the webinar, no problem. It's a pleasure for me to share those information with you as well. So topics for today. Yeah, of course, I will have to answer two questions coming about the mean reversion strategies. There's still one question open. I apologize for that delay, but I will do my best. So for me, time is right now quite busy, and you will later realize why. Then I want to show you one indicator for the trading platform MT4. That kind of indicator might help you for your own trades. And if you want to have that indicator, even then, just send me an email and I will send it to you via email. I cannot upload the indicator here because the file format is not allowed. I can only upload PDF documents, therefore that's not possible in that way. But anyhow, it's a tool for MT4 and it helps you for your own trades. Then the main topic for today is about open range breakout strategies. That is quite mighty basic strategy, and you will see how I personally manage that strategy, and I will show you all the steps to a complete portfolio of an open range breakout portfolio. And the reason is I have done a lot of work with that kind of strategy during the last couple of weeks, and now it's time to release that strategy. But of course, it's a good time to talk about the basics and how to do that kind of strategy. We will introduce a methodology, and that is called Walk Forward. That methodology helps us to do something in the past which we do today or tomorrow with our own trades, and that is quite important to apply those kind of methodologies whenever you can, and you will see, especially if we go to smaller time frames, then we can apply that methodology very good. And that creates finally the open range portfolio on about, I think, 8 different underlyings which will be traded with that kind of strategy. Go. So let's start quickly. So unfortunately the questions are this time once again in German, but I will translate everything which is necessary in order to have you here within those kind of questions. Both are related to the mean reversion strategy we discussed during the last couple of weeks. And by the way, even that kind of strategy will be will have some follow-ups, of course. And there was one question regarding the opening of a trade. Within all the Excel sheets I have presented during the last webinars, I opened all the trades within the Excel sheet at the close of, let's say, the today candle. The question is simply what might happen if we open the trade at the open of the next candle. Now it depends a little bit on the underlying. If you have an underlying which is not traded 24 hours, of course, then there might be a bigger difference. For underlyings like Forex, and if we don't look right now for the Friday-Sunday potential gap, then there is more or less no difference. Because the close of a candle and the open of the next for Forex is not always, but most times it's quite close. So in principle, I cannot really estimate the difference, but what I can say you, whenever you do your own activities within Excel, for example, you can simply change it, and then you can investigate the outcome. But besides 100, because we used values for the normal trading hours, I don't expect huge changes. The other question has been related to whether we might do a systematical error with those kind of mean reversion strategies. You might remember that we use the standard deviation as one basic figure, and we used a multiplier on that standard deviation in order to set the threshold when to open a trade. And of course, since the standard deviation of the difference between the EMA and the actual value, and we use that standard deviation for the complete period of history, that number, looking to the past, contains numbers of the future as well. But in principle, I have only introduced the standard deviation to make it a little bit more simple for that strategy. Because if we change the EMA, we would have to change the threshold by, there's a strong dependency between the typical applied threshold and the EMA. If we use large EMAs, then the potential deviation of our EMA and the actual value might get a huge number, and that would mean we would apply bigger numbers for that threshold. So in principle, to use the standard deviation was only a shortcut to not always change everything, but it's not really taking into account the future into the strategy. So, and by the way, the guy who asked that question sent me an email. Hey, not sorry, but I have realized that was not really intended. That we use the future, and we do not use the future because it's a simple figure in order to set the threshold. So no mistake. But anyhow, I'm always I thank everybody to make those remarks, because also I make mistakes. So potentially there might have been a mistake, and yeah, it's a nightmare to include the future into a trading strategy within Excel and other tools. It's quite easy to do that in principle. But then we have to wonder why the strategy is that profitable, and that would have no meaning. So that is one of the biggest mistakes one can make, to include the future into the strategy development. But in this case, we not really included the future into the strategy. Good. So I told you already that I want to distribute an indicator for MT4, and by the way, that indicator only works on ArgusFX accounts. I think within a month or so, then with the normal updates of MT4 with ArgusFX, they will include the indicator anyhow. So then it's part of the standard installation. But I can show you already the indicator, and if you want to have it, no problem, I will send it to you. And that indicator, what does it do? It shows the trades within MT4 visually. You know that you have a trading history of your account, and then you can see your trades, but only by numbers. But it's much more impressive, and you can learn much more if you have those informations of old trades within the chart. And that is, we do it via an indicator which have been programmed by Peter Milner, and that is a quite useful tool. Let me quickly show you how to install and then how to apply that indicator. I use now 2 different computers to do that task because I want to show it use the installation on a Windows computer, and later I will apply it on a Mac computer. The only reason is because that account we right now see here does not have any history of trades, therefore I cannot really show the result of the indicator. So how to install? It's quite easy. The only thing you have to do is you go in MT4, then you go to Open Data folder, and then assuming that your indicator is in the download folder or wherever that is finally, then this is the name of the indicator, and then you copy that file, and then you move back to the MT4 folders, and you see here a list of different folders, and one is named MQL4, and that is a folder for all expert advisors, for indicators, and so on and so on. And we go to the folder indicator, and now we paste the file here, and you see now I have this file within the list of indicators. And now you have 2 opportunities to get that indicator up and running. One is you close the MT4 and restart it, or you do a right-click here on that indicators, and then you press refresh, and now it will reload all the indicators which are available. And now you see here this AFX history orders, and how to apply. I show you in a different MT4 because there I have more history, and but everything looks is the same. I have the indicator here, AFX history orders, and the only thing you have to do is that you take that indicator and you drag and drop the indicator on a chart. And you can, by the way, then change colors and so on. But if you just use the standard settings, it might work for you already. And then let me zoom a little bit here in. Then, for example, you can see lines like this one here. And you have in the middle, let me zoom once again. Then you see, for example, here a green line, and that green line indicates a trade which has been done on that specific symbol. And in the standard color settings, every green trade is a winner trade, and every red line would indicate a loser trade. That means, of course, this trade here has been a short trade, and because it's green, it was a trade with a profit. And let me show you some additional examples simply by changing the time frame. Then you can see here now additional trades in the history, and you see a long green line here that indicates a note trade on Euro Canadian dollar. And by the way, if you do that mouse over functionality to that line, then you see all the details of that trade in numbers. But for me, it's quite important just to visualize all the trades because then I can see what happens within a specific account, and that is much more meaningful than just looking to the account history. Let me look. Yeah, now we have some red lines here as well. So that has been loser trades within that kind of symbol, and it only the only target for that indicator is to show all the trades within a specific symbol. By the way, I have one thing to mention. The indicator always takes all the trades listed in the account history. So if your account history is limited to, for example, 1 month, then it will only show the trades of the last month. So whatever you change in the account history to show all trades, that will be available for the indicator as well. So that's all. Quite easy, but I think it can help you very good to monitor your trades visually and in order to set some conclusions about those trades like here. Okay, that's by the way all for that kind of purpose. And if you want to have it, just send me an email and I will send you a zip file with that indicator, and now you know how to install. Yeah, the indicator shows all completed trades, not open trades, so not running trades by lines in the chart, and it will update automatically once you have drag and drop the indicator on the chart. So it's a nice tool for everybody. Good. But now to the next kind of principle of strategy, and how does it work, and what are the basics of that kind of strategy. Let me illustrate it a little bit with that figure here, just to introduce you in this kind of trading strategy. It's called open range breakout. And what does it mean? Let me describe how the picture has been derived. What we see here, by the way, is a part of an old chart of an M15, so quarter-hour chart. Every candle is 15 minutes, and that is, by the way, I think it's a euro Japanese yen. And the chart, or this figure, has been developed first with 2 vertical lines. So there was one, or there is one vertical line at 0 hour, so at midnight. This is the one with the current cursor position. And then there's another line, and the other line here, the other vertical line, has been set to 8 o'clock. And so that 2 vertical lines create the time range. And now the next step is quite simple. You look for the maximum of the price within that time period, and then this would create another line here at that position where the cursor is right now. So that red line, and behind the red line, by the way, is a gray line, because that has indicated the high within the time period. And then you look for the lowest value within the time period, the lowest price. And now it's not still visible because this red candle here has a line downwards exactly to that position here. So there's a minimum of that range. So now we draw a horizontal line at that value. So at the upper, at the down limit, the lower end of the range. So finally, we create that rectangle here, that gray area, which is derived by 2 times and by 2 prices. So that is a range we want to look now. And the basics of range breakout trading activities is simply that whenever we have 8 o'clock in this case, then we place 2 orders. One order is a long order at the upper limit of the range. So we place this buy stop order at that upper limit here, and we place an additional order. So we place 2 orders, and we place a sell stop order at the lower end of our range. So we have 2 pending orders in the market exactly after 8 o'clock. So that is our starting position. And now we wait. We wait until one of those 2 orders is filled. So what does it mean? It means that either the price goes through the lower limit or it goes through the upper limit and fills the potential order. If an order is filled, then we cancel the other order. In my case, the short order has been filled. I think it was this candle here, where my cursor is right now, and no, it's a little bit earlier, by the way. Now I see it. Here at that position, the short order is filled, and our order, we are short in the market. So now we hope, or we assume, that the price will go downwards further. So at that time, we would cancel, we would delete the long trade, the buy stop order on the other side. Finally, that means we apply what is called OCO. One cancels the other. It cannot be done automatically without additional measures within MT4, but of course we can do it manually just to delete the other order. Or finally, you can do it via expert advisors, then they will do the job for you. So, but now we are short in the market from here onwards, and in this case, as by the way, as always, if somebody talks about a strategy, he uses an example which works, but that you know. And now the price goes further to the south, and that is exactly what we intended with our trade. And now we have set a take profit for that specific trade. In my case here, I put the take profit exactly at a risk-reward ratio of 1. What does it mean? So the distance, or the range itself between those 2 lines, that distance has been applied to the lower end and has created the green line, which indicates the take profit of that specific trade. So what we have here, we have a take profit exactly with a risk-reward ratio of 1. And finally, around 1 o'clock p.m., our trade has reached that take profit, and the trade is done. Good. So that is the basic of any breakout strategy. And I will, on the next slide, I will show you some more examples of how to modify the kind of strategy. For me personally, I use that kind of strategy only, by the way, in finally 2 manners, or in 2 different ways. And in order to come to that 2 different kind of strategies, let me first look a little bit more mathematically on that open range breakout strategy, because I have made a picture here that all of a sudden I said at midnight I start the range, and at 8 o'clock the range ended. Okay, that number draw from the sky, or fall from the sky, so to say. And in principle, I could use time periods, for example, between 1 and 10 o'clock, or 8 and 12 o'clock, or whatever. You see, we have degrees of freedom for that kind of strategy. 1 degree of freedom is the open time of that range. In this case, midnight, but all other times would be possible as well. 1 o'clock, 2 o'clock, 3 o'clock, whatever. The next degree of freedom is the range close time, because we can use different times if we want. But in order to define finally the strategy, we have to decide for specific time frames, for specific time periods, open time for the range and close time for the range. So we have already 2 degrees of freedom for that strategy. The next one is, in my case, I applied a risk-reward ratio of 1, or within my language of any strategy, the so-called take profit multiplier. By the way, I have not mentioned where to set the stop loss. Let me start with that first, because the stop loss is quite easy. Stop loss is always on the other side. That means for the long trade, which has been set here at the red line, the stop loss has been the lower end of the range. And for the short trade, the red line has been the stop loss of the trade. So the stop loss itself is not, in this case, a degree of freedom, because the stop loss is taken from the strategy description, or how to set up the strategy. So stop loss is given and no degree of freedom, at least in my case. One can use different kind of stop loss methodologies, but in my case, the stop loss is given by the strategy itself. But the take profit multiplier is a degree of freedom. In this case, it was 1, but I can apply 1.5, 2, 2.5, 3, or whatever number. Or even numbers smaller than 1 would be in principle possible. So it's the 3rd degree of freedom of that kind of strategy. Later, it turned out, during the investigation of that kind of strategies, that it's good to have a 4th degree of freedom. And the 4th degree of freedom in this case is a minimum range. What does it mean? If the range, which is created by the 2 vertical lines and then finally by the 2 horizontal lines, if that range is on the price axis too small, then it's not good to open any trade. The simple reason is you have to consider that we have to live with the spreads of every underlying as well. Think about, we have a very small range. Then only by this random behavior of all underlyings, we might open a trade, and then after some wiggles are up and down, we are already stopped out. So if the range is too small, the potential to have a very fast reach of the stop loss is quite with a high probability. So to not trade if the range is too small is a quite good idea, especially for those underlyings with higher spreads. Therefore, I apply a so-called minimum range. If that minimum range is not achieved or not reached, then I have at that day no trade. And I mentioned now at that day. I use that kind of strategy as an intraday strategy. That means if a trade is opened, I close a trade at 10 p.m. By the way, I could close the trade a little bit before 11 p.m. because that is a time when swap costs are applied, but I don't want to have swaps here within that strategy, so therefore I close all open trades at 10 p.m. So they have what I personally call a time stop. So whenever 10 o'clock, then close trade. I don't want to have overnight trades, and especially what I don't want to have is a running trade at the next day when the next range is created, because now I would have to answer the question, hey, should I open another trade, maybe in the other direction? And to avoid all those kind of questions, I simply decided to close all trades before midnight. So I have no overnight trades within that kind of strategy. That you see a little bit how the strategy works, I will try, and I hope that our internet connection is fast enough. I will show you now, yeah, more or less a video, and let's see how good we can talk together about that kind of video. What you see here is another underlying, I think it's US dollar, Japanese yen, and what you see, we have a specific date here, 10th December 2013, and we see some candles, and that is the price of that day, or all the candles are real candles of that underlying. And now I stop the movie because I want to first show you how the movie works really. And within that movie, you see sometimes black squares and sometimes green squares. The color green indicates that the minimum range has been fulfilled. So the range is big enough in order to place orders. So in this case, let's look for the last green square here. We originally have had 2 orders, like in the last picture, like in the last chart, along by stop order on the upper side, and on the lower side is the sell stop order. Within that candle, the order has been filled, and we are long in the market, and this indicates either time stop or the reach of a take profit. And now let's look a little bit more to the movie. Range is big enough, short trade is opened, and now that was a time stop, trade is closed. Next day, new range, and finally, there was no trade, by the way. I stopped the video. Now, the green box here has never been left. So at that day, there was no trade opened because we did not leave that range, and therefore no trade has been done. At the next day, you see that we have a black box now, and black box means, hey, no trade because range is too small. Let me move a little bit forward, and you see that we have a lot of black boxes, meaning, oh, no trades, and maybe on the next day the box is big enough. But now, I stop once again, look for the date. We are around Christmas, and around Christmas, in most cases, the markets slow down, and therefore it's not untypical that we don't have huge ranges within those dates. By the way, those kind of movies I do not create only in order to illustrate something here for people like you. So let's call it for marketing purposes or something like that. No, I do that kind of effort simply to visualize how the strategy works, because that helps me to control and myself in order to see, does it work, does it not work, and is it doing right? So is the logic right? So therefore that helps. And I create those kind of videos via C programs as well, or to be more specific, I create pictures and then I put those pictures together to a movie. But anyhow, so that is how the strategy works. And by the way, within the inlet of this chart, by the way, you see one result for US dollar, Japanese yen. That is the equity line for about 10 years with a fixed set of parameters. Fixed set of parameters. That will bring us to one of the most important next topics. But before doing that, let me explain you some potential variants of that kind of strategy. In my case, I use the OCO principle. I have two orders always when the range end time has been reached. After that, I have two orders, and then I use the OCO principle in order to cancel the other one if the first one has been opened or filled. You might not have two orders. You might use an EMA as a filter for preferred trade direction. So you can say, okay, only if the price is above the EMA, then I open or I place a long order and a short order only if the price is below the EMA. That would be one potential filter. But that is something you can do or as a variant of that kind of strategy. Or what you might do is you use so-called dynamical range. Dynamical range would be created by a fixed number of candles, for example. So you can say, okay, I look for the last 24 candles and they create my range. And if I now leave that range out, which has been created out of those 24 candles, then I open a trade. If a trade is opened, I don't wait for, I don't look for any new ranges. I wait until that trade comes to an end. If not, if the trade is, if the order is not filled, I can, after the next candle, I can look backwards. Hey, new range, new orders, and that would be a dynamical range breakout. So that is in principle one other category of open range breakout trades. Or you might change the strategy by using another stop loss setting. For example, just half of the range. So not the other side of the range as a stop loss, for example, just half of the range or any other fixed value. So I don't want to use that as a degree of freedom. So just set a value and then investigate whether that is good or not. You can even use other time frames. So for example, you can say, I do a range breakout strategy if you look for the last day. That might be applicable for example, DAX or S&P 500. You simply look, hey, last day has a specific range. If the new day starts within that range, you apply those two orders, one to the upper side and one to the lower side. So also that might be a potential variant of that strategy. Or you use trailing stops instead of a fixed stop loss, and then you might take the trade overnight, whatever. So a lot of things can be modified. So there are thousands of variants of breakout strategies, and it's a quite interesting tool. The common idea and basic assumption of all those breakout strategies is that the breakout itself is sustainable and will last a little bit longer. So that's all. But now I said, let me introduce another methodology here. And that methodology is called walk forward methodology. Normally what we do when we use or we develop a strategy, or if you look what we have done to all our mean reversion strategies, we have looked for a complete set of history. And then we have optimized, we have changed some parameters of the strategies in order to find out good values for that kind of strategies. And then, having done this, our assumption is that we trade from tomorrow with those parameters, we will have good results as well. But that is an assumption. That assumption is not bad because, for example, if we look for 10 years history of whatever and we find some good parameters, why not we would have good results at the next days or weeks. But in principle, it might change. But let me repeat again, it's already good what we have done if we would have done only the first step here. Why? At least what we have done is we showed that our strategy works. Whether we can really live with those parameters in the future is always a question for any strategy, whatever you do. But at least you have shown yourself for the history it works. But now the work forward methodology is quite simple and helps you to get even more confidence for your parameters. And what you do there is you do in principle the same what we originally have done for any other strategy. But now you restrict your history to a certain amount. Let's say only 1 year or 2 years of data. And then you go far in the past. You optimize, let's say, this breakout strategy for the years 2003, 2004. And then you find some good parameters for that period in time. And what you do now is you apply those parameters to the then upcoming future, which is the future with respect to the optimization, but still you have those data. But those data have been not part of the optimization process. And that's a good thing, that we apply our strategy with those parameters in the future, in the past. And then you repeat that process iteratively. So you move forward within the history. Before illustrating that kind of process, let me state that mathematically this means we have a reduction to 1 degree of freedom. Originally, within my strategy here, we have had 4 degrees of freedom, and then finally we have only 1. Why only 1? Because there's still 1 open degree of freedom now, and that is the length of the history. I mentioned, hey, I optimize within 2 years. Maybe I optimize within 3 years. So 1 degree of freedom is left. So in order to illustrate that process, let me quickly show you that kind of a picture. We have here nearly 7 years of history for some underlying, and doesn't depend on which underlying. And you see that I have here 2 boxes, 1 green box and 1 red box. And that means now within the green box, that is a period of time I do the optimization process of the open breakout strategy. Having set the parameters for that period, I apply those parameters within the red box. And what I do, and I record all the trades which have been done in that future in the red box. Then what I simply do is I move that windows exactly by the length of the red box to the right. And now, once again, I do the optimization process within the now green box and apply all my rules for the upcoming future, and so on and so on. The final recording is done always only for the trades within the red box, because those trades have been done in what I say now future. And that process can be done iteratively, complicated word, until today. And what I do from today is simply the same. Now I optimize for the green box once again, and I look and I apply those parameters in the real future. So the good thing is I have practiced my kind of strategy in a complete history. I now look only to the trades in the then coming future. So the coming future has never been part of the optimization process. And that is the same like today, because now the green box ends at today, and tomorrow I want to trade real live in my account. And that is the kind of, or the methodology walk forward. It costs a lot of computer time, by the way, because you have to do that process once again and again and again. But anyhow, finally you get equity curves only for history trades. So that is quite good and quite helpful. Good. But how does a result look like? And still we have the question, what should be the length of the green box? And the length of the green box is the remaining degree of freedom. So it's the length of the applied history for the optimization process, which finally has been done iteratively during the complete history of available data. In order to show what I do here is, I first want to share with you an Excel sheet like this here. What you see here is simply the results of Euro, Japanese yen for different numbers of lengths of history, and the numbers are days. So 500 means about 2 years history have been investigated. And then, by the way, I apply it for 11 days in the future. And then I do every step once and forward. So what you see here is the result in terms of profitability, just the number R, or in terms of R. So 100 means profit of 100 R have been achieved. And then you see different box lengths, and they vary between more or less 0 and 1000, which is about 4 years. And you see, and that is something which is very good. Finally, the result of that strategy does not really depend on the length of the history, which is a very impressive and good result. That we have not that bad values for a very broad range of history lengths for that green box for the optimization process. So that is indeed quite impressive that we have good numbers. And now the step is, hey, what number or what history lengths should we take? And that process is done not really in that kind of chart, because I don't want to look just to the profit itself. So what is here is a profit after the complete period of time. Finally, I look for drawdowns and linearity of the equity, as mentioned already earlier in our webinars. So it's not that chart in order to derive the final numbers. It's more something like you might remember that I have the key figure opti, and the lower the better. And then you realize already, hey, this would be the range I would use for my final strategy. And by the way, yeah, it is 312 days in this case. So I look for neighbors there once again, broad ranges in order to be on the safe side. And yeah, that is done for a couple of underlyings. And finally, it turns out that I can use that kind of strategy for different underlyings, but not for all underlyings. And in order to show you one result, in this case, only for Euro, Japanese yen, then you get an equity line which looks like this. And you might think, okay, unfortunately, I have a big drawdown here at the very end. I can only agree. But we see good moves, good up moves here within other periods. But nevertheless, think about how the strategy has been derived and how the numbers are, how the trades, that is always only trades in the future. So I like that equity curve finally, because it has a positive slope. And what I can do now is I can simply use a portfolio and look for other underlyings, which can be traded similar with their own set of parameters for range, times, history, and so on and so on. And then I can create a complete set, a portfolio of different underlyings. Finally, I came up with 8 underlyings which I use, and those underlyings finally create me an equity curve which looks like this here. Everything is done dynamical, so everything is done back via this walk forward methodology, and then this is the sum of 8 different underlyings, and I will name them later. And the process for optimization has to be done, even for the real future, every 11 days, because that was my rule to set up new parameters every 11 trading days. So that is the total sum of the 8 underlyings, and that is, of course, a new kind of strategy. What does it mean? Finally, this looks like this here. So I have my 8 underlyings, and I have different times for those breakouts. You see, for example, I have a breakout time for Australian dollar, Japanese yen between 8 and 10. For gold from 4 to 11. For Brent oil from 8 to 12. And so on and so on. And that numbers are now. So now means those numbers are applicable right now. But they will change, because all those numbers change over time. Not very often, but from time to time. And that they change is good, because that adapts the nearer future of history to the real future, and therefore the strategy itself changes. It changes the range times, and it changes the range multipliers and the minimum ranges, for example. So if the market changes, the strategy will change as well. And that is very good, that we have a self-adapting strategy finally. So I don't care now about the questions, what is the current condition of the market? And if the market changes, this kind of methodology will learn how the market has changed and what kind of changes for the breakout scenario should be done. So that is very good for us that we have that kind of methodology. And yeah, that is a new strategy, by the way, for our portfolio. And that brings me to my last topic. What kind of new strategies do we have? So we have had already 2 strategies which have been introduced in the last webinar. That was Euro, Japanese Yen range breakout. Even that was a range breakout, but only on a single underlying and with a slightly different methodology. In this strategy, I use indeed an EMA for a preferred direction of the breakout. And the other strategy, which has already been introduced, was a class trading strategy. You remember that we have had a couple of months ago, this was in our webinar series as well. So those 2 strategies has been already released in the last year, or in the very end of last year. And there was one additional release, I think close to Christmas, slightly after the last webinar. That was the so-called regression line D1. Which is from the basic principle something very similar to the mean reversion strategy. So in this case, for that strategy, I use a 4,000 euro account, and I trade on 10 different underlyings with a risk per trade of 15 euros, and the allowed drawdown for the strategy is 25%. So the trading activity is not that huge, but it's about 15 trades per week. And now the one we we talk about within that webinar is the open range walk forward strategy, and that strategy will start tomorrow. So I will release that strategy here, and then the account size is once again a 4,000 euro account, and you see the different symbols we will trade within that kind of strategy. So it's a portfolio of 8 different underlyings. The risk per trade is 16 euros, and the allowed drawdown for the strategy is once again 25%. So the trading activity is about 22 per week, and you might do your own calculation. Hey, 8 underlyings, 5 days. So in principle, there might be 40 trades a week. And why we have only typically 22? Quite simple answer, 2 reasons. One is minimum range. If only if the minimum range is achieved, then trades or orders are placed. And the other one is it might be that we have a range and we will not leave the range until 9 p.m. and then there's no trade. So therefore the number is lower than the potential 40 trades. So in average it has been 22 over the last 10 years. So this strategy starts tomorrow, and you can follow if you want those on the Argonaut platform, and all is done on the so-called Lambda strategies, who's the owner of all those activities. Good. So that's something. If, by the way, if you have any questions how to do that, and you are not familiar with how to set up this Argonaut, it's quite easy, but I can help you if you want. And finally, that means you can follow those kind of strategies, and but you can set your own risk settings via multipliers or via equity multipliers between those accounts and your own accounts. Finally, it means that all trades are copied directly from ArgusFX into your account. You can still then manage those trades, or you can at least you can close trades still within your own, and it's still absolutely your account, and nobody else has access to that account. Good. Wow, that's already 1 hour once again here at Thursday morning. I hope that you have got a good feeling about an additional strategy, this open range breakout strategy, because that is really something I can recommend for your own trading activities. You can do it manually, just looking to charts, looking to breakouts. You can create quite simple your own approach, what kind of times you use. Then you can use dynamical ranges for the history, whatever. So the space is wide open for breakout strategies. And my personal thinking, why do I like breakout strategies? Because they are a little bit of an anomaly of the trade or the price history, and everything which is not usual is good. And breakouts are not usual in the sense that that they might end up in huge moves in one direction, and that is something which cannot be created randomly. And you might remember that we talk about that prices in our markets have a lot of to do with random movements. So they are what I call a deviation from that random behavior. And therefore, that is something which belongs, I think, in every portfolio of trading activities. Okay, that's for now. Hope to see you again next week, same time, 11 o'clock, at least German time. And have a good day and have a good week. See you. Bye-bye.